Hello and welcome to this Markets Today special. I have with me today Anand Shah, who heads PMS and AIF at Prudential ICICI or ICICI Prudential Asset Management Company. Anand, very good to see you today. But let me start by asking a very simple question. How difficult has it been for a fund manager like you to beat the market over the last 1 year? I mean, the benchmarks that you follow or adhere to.
It's been a pleasure to be here. Thank you for inviting me. I think last 2 years, 3 years have been actually easier than what it was before. Uh, Prior to around January 2020, we had a very narrow rally in a very specific end of the market only. And a very broader market was underperforming the index. Having said that, last 2.5, 3 years have been actually where the profitability across broader market has been much better than the blue chips. And to that extent, stock picking is actually working wonderfully over last 2.5, 3 years. So last 2.5, 3 years have been pretty much easier, and also it's actually a stock pickers market. So a lot of alpha also is something we could generate in last 2.5, 3 years.
So, what are the sectors and stocks that have resulted in the alpha that you've been able to generate? I mean, relative to the market, what are the bets which have worked out for you?
Yeah, so I think if I go back a little bit into the history, what was happening was you had, as I was saying, a very narrow segments of the market doing well, and partly that was also to do with that. If you were a manufacturing something, if you're a manufacturer of something, you had a very stiff competition from China. China was practically the factory for the rest of the world, and they would produce from safety pin to boilers, from tire to tiles, whatever you need, they would manufacture it for the rest of the world. So globally, ex-China manufacturing was struggling. But in the same time, if you're a consumer of those manufactured goods, would be a typical consumer or a consumer-facing businesses which were doing very well. What has changed in last few years, and precisely more forcefully in last 3 years, is China, which was an exporter of deflation, has become an exporter of inflation. And to that extent, a lot of manufacturing and manufacturing allied businesses, which includes corporate banks. So even within banks, if you see, a lot of corporate banks which were also at the receiving end of stress in manufacturing, stress in infra, leading to a very large NPAs and so much so provisionings for the same, have also seen reversal of fortunes. So I think our focus on manufacturing allied corporate banks, these are the areas where the earnings growth has been strong, valuations were very reasonable to start with, have helped us generate a lot of alpha.
But alpha is also generated by staying away from underperforming sectors. So, which are the sectors which you have ducked over the last year or so, which has resulted in you beating the index?
Yeah, so through the last 2.5 years, we've been avoiding consumers. Last 1 year, we didn't have any IT in the portfolio. We didn't have any pharma in the portfolio. These were again, businesses were great, but they were priced for a far more growth than what actually was. So we've sort of avoided businesses where the growth was mispriced. Our reading of the market told us that the growth that market was expecting was not possible. So those are the sectors we avoided, which also helped us generate a lot of alpha. Right. That's
No, but this is an interesting conundrum for you because some of these franchises in consumers and even IT, I would say, though more consumers, they're actually very good companies. The valuations may have been wrong. So at what point do you say there has been enough time and price correction, at least time correction, and one might look to recalibrate the portfolio somewhat? Are we anywhere close to that? Or do you see the underperformance lingering for many years?
So I think what we are looking at, today, the good news is that a large part of the economy will do well. This was unlike pre-2020, where a very small segment of the market was doing well. And to that extent, the challenge is now what are the sectors, what are the companies where the growth would be much better than expected, and what are the businesses where growth would be lower than what the market is expecting. In some of these businesses, especially in consumer-facing businesses, what was happening also in last decade or so, you had massive margin expansion on the back of low inflation. So your input cost was not going up. You had enough pricing power on the consumer end. So you actually had between 600 to 1200 basis points of margin expansion. What is going to happen in years to come is China, which was an exporter of deflation, will export inflation. At the same time, your consumer is still stressed. It's not. It's been a K-shaped recovery. We have been talking about it for a while. So it's not that consumer is ready to pay you for that inflation. And to that extent, what we are expecting or what we are fearing is many of these businesses have still some way to go where the margins can shrink further. And to that extent, we are waiting. Again, not that these stocks after the underperformance have become, very, very cheap. The valuation still remains steep. People's expectations are very high from them, both in terms of growth as well as return on equities. And our take is both are, challenged at this point of time. Some of them will have incremental competition also. Like paints industry, you're seeing there's so many new players entering. Similarly, in many of brand businesses, there are D2C brands which are coming up. Also, there is a ownership of customer, whether it belongs to the consumer business or whether it belongs to the organized retailing. So those are the challenges which are there in those sectors. So they're evaluating them on a regular basis. We have a very large team of analysts which tracks all these sectors. But as we see today, the risk reward still remains favorable for the businesses that we've been owning for last 2 years, 3 years, which is manufacturing, manufacturing allied, and corporate banks.
Right. Another consumer facing sector, though I don't think you were talking about exactly that right now, autos. Where does that stand in your portfolio?
So again, we've been underweight auto, we've been overweight auto anchs. So again, if you see, auto businesses were also beneficiary of benign inflation, and they're more consumer facing, have more distribution strength and brand power for pricing. But somebody who was an auto ancillary was at the receiving end during last decade. The other further challenge to auto companies has been fragmentation of the market. You have new players coming in, uh, or the new segments of the market, like SUVs, are doing better, where you have more number of players. You have EV risk, which is around the corner, where again new set of businesses are coming in and challenging the leadership position, which had been there for a while. It was a status quo in terms of leadership in various segments of the market. So you have increased competition, a technology change which will be there. It's a matter of time, but sometime when ICE to EV is another risk. So auto is something we've been sort of underweight uh, as far as our portfolios are concerned.
You said that you were quite bullish about corporate banks. Now, how do you play this? Do you play ICICI, Axis, and Kotak and leave it at that? Or do you go down the ladder to look at some of the public sector banks which are doing quite a bit of corporate funding? And where does this leave some of the banks which we are thought of as more retail focused, like HDFC, which have underperformed the likes of ICICI in recent years?
So while I spoke about only corporate banks, but if you see broadly, the banking system is going to do very well. I have a reasons to believe that there are many reforms, many changes that will happen in banking industry, which will lead to far better profitability in years to come versus last year. I'll give you some examples like surfacing. Now, Surface is made sure that more credit is available for home loans. Demand was always there, but now your ability to recover any monies from any defaulter becomes better. Similarly, you have IBC, then you have CIBIL, scorecards which are now available, or a GST data which is available. All in all, when these things are happening together, ability of a bank do an informed lending and a better lending has improved. So generally speaking, we believe banking system will actually have a far lower slippages in next few years than what it had in last few years. We know what has gone wrong. So structurally, we believe banking is going to do well. So that applies broadly for the entire banking industry. And to that extent, we own both private and state-owned banks in our portfolios. Given that we believe credit cost will be the key driver for profit growth rate, for higher return on equities for the banking industry in general.
Where does it leave NBFCs, the larger ones like the Bajaj Finances of the world?
So I think NBFCs actually had a very good time when banks were under stress. They were struggling with recoveries from their existing NPAs. Some of them didn't have capital to grow lending, and to that extent, there was a period of time when the competitive intensity from banks was far lower. As we go forward, we believe more and more banks would have capital. More and more banks have lower stress on the existing book. You can guide the people back towards lending. So overall, very broadly speaking, I see the competition from the banks will be increasing, and some of the business which was easily business of banks customers which you were able to lend would become that much more difficult. But nevertheless, India is underpenetrated as far as retail lending is concerned. Indian household can continue leverage. So for the good banks, for the good NBFCs, notwithstanding some businesses would have a challenge of valuations. But overall, from a performance point of view, growth and profitability perspective, many lenders in India can continue to do well.
You are bullish on manufacturing, but how do you reconcile that bullishness with the valuations that we see in capital goods stocks today? Because, they seem like a good space from a business perspective, but they have gone up so much, and now it's difficult to find stocks which can be called reasonable by any stretch. As a fund manager, how do you reconcile that?
No, indeed, I agree with you to some extent that in pockets of the market, the valuations are steep today as we see. But you have to also appreciate that this is a multi-year story, is the way we see. China is now incrementally a very prosperous country, and to that extent, the cost of labor in China is going up. Pollution costs in China are going up. Even the government policies are more oriented towards high end of manufacturing. So there is very clearly, and it's not unique to India, globally, be it Vietnam, be it Southeast Asia, be it Africa, there are many countries across the emerging markets which will benefit as the low end of manufacturing gets transferred out of China. So I think within the manufacturing space, the low end of the manufacturing, which is relatively cheaper, still remains attractive. Coming to the capex cycles, I think many of these rally, the sharp move in the capital goods is also an expectation that we will see capex cycle from India Inc. India Inc. has deleveraged. The banks have become that much more stronger today, both from a capital adequacy perspective as well as their ability to lend. So I think this is more of an expectation. I think it's a continuous journey to evaluate. We believe there is China plus one. The world will need India to invest into new capital capacities to provide for consumer goods, provide for the goods required in US, in Europe. And to that extent, both China plus one, Europe plus one at the play, I think private sector capex is what can justify these sort of valuations which we are seeing today.
Anand, great talking to you. Thank you very much for your thoughts and insights today.
My pleasure. Thank you.
Thank you very much.
If you like the video, do like, comment, share and subscribe.